Ladies and gentlemen, good day and welcome to the Raymond Limited Corporate Initiative Conference Call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu from Antique Stock Broking. Thank you, and over to you, sir.
Thank you. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Raymond's Corporate Initiative call. We have with us from senior management Mr. S.L. Pokharna, Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Jatin Khanna, Head of Corporate Development, and Mr. Harmohan Sani, the CEO, Raymond Realty. Now I would like to hand over the call to Group CFO Amit, who will give you a brief summary of the company's corporate initiative. Over to you, Amit.
Thank you, Abhijit. Good evening, everyone. Thank you for joining us today on this call. It gives me an immense pleasure to share that Raymond Limited Board has approved the demerger of its real estate business, marking a step towards shareholder value creation. Raymond is on a transformative journey and has taken several strategic initiatives to enhance the shareholder value. We sold our FMCG business for 2,825 crores last year, making the Raymond Group net debt free. Demerger of its lifestyle business got completed on 30th June 2024 and 11th July 2024 is fixed as a record date for the lifestyle business demerger. We acquired Maini Precision and doubled our engineering business to over 1,800 crore revenue and forayed into sunrise sector of aerospace, defense and EV component business. Yesterday, Board has approved another corporate initiative for vertical demerger of its real estate business from Raymond Limited into its wholly owned subsidiary, Raymond Realty Limited or RRL, and the process of demerger is expected to take anything between 12 to 15 months and will create Raymond Realty Limited into a pure play net debt free listed real estate entity. The record date for this demerger will be announced once all statutory approvals are received. These corporate actions align with our vision to simplify the group structure and to create pure play net debt free listed businesses, offering investors the opportunity to invest based on their investment philosophies. Following the completion of the lifestyle business demerger on 30th June 2024, Raymond Limited comprises of two primary business, one real estate and another engineering business. Pursuant to the real estate demerger approved by the board yesterday, all the assets, liabilities, debt and investments relating to the real estate business will get transferred to Raymond Realty Limited. The group has embarked on a journey where once our businesses achieve certain scale and maturity, we will create pure play businesses for unlocking shareholder value. The demerged real estate entity will seek an automatic listing on stock exchanges and according to the scheme of arrangement, each Raymond Limited shareholder will receive one share of Raymond Realty Limited for every one share held in Raymond Limited. To ensure utmost transparency and fairness, the share entitlement report was taken from independent valuer KPMG Valuation Services LLP and a fairness opinion from Access Capital Limited, and which was approved by the board of directors yesterday. Raymond Realty, which primarily engages in the business of real estate development, has two revenue streams: development of its own 100-acre Thane land parcel and another from the asset-light JDA model. The Thane land has the revenue potential of approx 25,000 crores with 11.4 million square feet RERA-approved carpet area. Currently, we are developing almost 40 acres with RERA-approved carpet area of 4 million square feet and a revenue of 9,000 crores. The trust in our ability to build, sell and collect fast has given us a competitive edge. Our commitment to timely delivery and high quality standards is exemplified by delivering the first 3 towers of the project 2 years ahead of RERA timeline in 2023. This success is reflected in our high sell-through rate, with which over 65% of inventory at Thane has been already sold. This efficient cycle demonstrates our operational excellence and strong market demand for our flats. Now, let me talk about the asset-light model we have leveraged, and recently Raymond Realty has signed 4 JDAs in the Mumbai metropolitan region with carpet area of approximately 2 million square feet. The combined revenue potential from these 4 JDA is approximately 7,000 crores. And with the development of Thane Land Bank and current 4 JDAs gives the company a potential revenue of over 32,000 crores. The strategic move of demerger has come as Raymond's real estate business has achieved a scale of by reporting a revenue of approximately 1,600 crores and an EBITDA of 370 crores. With a booking value pre-sales of 2,250 crores in fiscal 24, positioning it well to chart its own growth path as a separate entity. The engineering business will remain in Raymond Limited. Post-acquisition of Mani Precision, the engineering business revenue has doubled to 1,800 crores and the consolidated EBITDA stood for the engineering business at 270 crores. Further, with the entry into sunrise sectors of aerospace, defense, and engineering and EV, enable us to grow faster pace. As we stand on this cusp of exciting transformation, I want to express my heartfelt gratitude for your unwavering support and trust in Raymond Limited. We believe that these strategic corporate initiatives will unlock significant value for our shareholders and enable each business to focus on its core strengths and growth opportunities. The newly formed entities will be better positioned to attract investments, enhance operational efficiencies, and capitalize on market opportunities. We are excited about the future and confident that these steps will lead to a sustained growth. Thank you for your continued interest and support. Thank you for the attention, and now we are eager to hear your thoughts and address any questions you may have about this journey which we have embarked upon. Operator, please take the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you wish to register for any questions, please press star and 1. Our first question is from the line of Deepesh Agarwal from UTI Asset Management Company. Please go ahead.
Yeah, hi. Good evening. My question is to Amit. Amit, can you help us understand the breakup of unallocable expenses between real estate business, lifestyle business, and the engineering business?
Yeah, sure. Basically, what happens is unallocated is directly because of the various businesses which we have and certain common services which we provide. I think over the next 1 to 2 months, we are going to work out a structure which will enable us to identify exactly that how much it is for the real estate business, how much is for the engineering, and how much is going to be for the lifestyle business, which we are in the process. So hopefully in the next 30 days, we should have that done.
No, but given that your lifestyle record date is next week, if you can get this number earlier, that would be much helpful for the investors. So also for the debt number and working capital.
For debt, very clearly, we have all the businesses which are net debt free, and clearly in the lifestyle, we are having at least as on 31st of March 2024, we were having net cash of almost 200 crores. And in the realty business, we have in excess of 500 crores of cash.
Okay. Okay. And what would be the working capital split between three businesses?
I think working capital, basically what would happen is, if I look at it in the lifestyle business, it should be in the range of 1,200 odd crore, the working capital, net working capital, and in the real estate it would be in the range of somewhere 500 crores of working capital.
And engineering?
Engineering could be 300 to 350 crores.
This would be including Money Precision acquisition, right?
Yes.
Okay. And what would be the timeline? Fair to understand, this would take at least a year to get the demerger of the real estate business?
Yeah, I think that we just have gone through one of the demergers. We have seen that last year we did announced in April of 2023. We are just completing now, as we said, 30th June. So it takes anything between 15 to 16 months, I would assume. We are trying to expedite, but I think generally it takes 15 to 18 months to get this behind us.
Okay. And any thoughts on the demerger of the aerospace business from the engineering?
Look, as we said, that we want to make sure when the businesses get matured, we have a very clear timeline that at these certain levels, we would do the necessary steps in order to unlock the value. And very clearly, if you see, we told long back, 3 years back, by 2025, we would be net debt free. And at that point of time, we had also indicated we would have the demerger. But since we got the possibility of selling the FMCG, reducing the debt and making net debt free in 2023, we took the action and we went out and did the demerger of the lifestyle business. And now, as the projects in Thane plus the JDA have started, the company has done very, very well in terms of real estate business. That is the next step we thought is most appropriate, that it can stand on its own feet very well. And it has also the growth capital available. And if you need to have a capital, because it takes 12 to 16 months in order to get this formed entity listed place, and real estate requires capital. If we need the capital at that point of time, it becomes handy to go out and raise capital. But as I said, we are sitting with cash of around 500 odd crores, which will enable the journey. And since we are selling very well, as you know, we have sold 65% of our inventory at Thane, and even the Bandra project, within 30 odd days, we were able to sell almost 55-60% of the inventory launched. So I feel very confident that you would not require a significant capital, but you need to prepare the companies to enable you to raise capital at an appropriate time when you need it.
Sure. Thank you. And just reiterating my request, if you can get the pro forma of lifestyle business earliest.
Sure. Would do so. Thank you.
Thank you. Our next question is from the line of Q1 MG from Tiger Assets. Please go ahead.
Hello. Thank you for the opportunity. What is the execution time period for the 32,000 crore GDV which you mentioned?
I think it will be over a 7-8 year period, because as you know, on the 32,000, you have 7,000 crores, which is the JDA led, which we have signed in the last 3 to 6 months, which takes to start the project anything between 1 year to 15 months, and then it's a life cycle of a 5 to 6 year project. So I think good enough to say 7 to 8 years should be the time frame.
Okay. Another question. What is the engineering business overall order book, growth visibility, and where do you see its visibility in the next couple of years in aerospace and defense business and auto business?
Yeah, I think it's simple. You know that today the business is in the range of 1,800-1,900 crores. We have got 3 broad segments into this. One is an aerospace defense, which grows phenomenally at a pace more than 25-30% year on year. Then you have the auto business, which is in the range of 1,200 odd crores, which also grows at a good 10 to 15%. And then you have the engineering consumable business, which is roughly 500 odd crores, which grows somewhere in the range of 8 to 12%. So I think overall as an engineering business, we believe comfortably over the next 4-5 years, you should be able to double from here, and also because the margins on the aerospace and defense is much higher vis-a-vis the auto components business and the engineering consumables, I think it will be sooner when you will be able to double the EBITDA. So I think the compounding on the EBITDA will be much faster, as we believe the growth in the aerospace and defense business is going to be much faster and much stronger. Look, at this juncture, if you see, India is just about 1% of the global aerospace components industry, and the vision as by the government as well as the major players is that we should get to 3 to 4%. And China Plus One is obviously helping into this cause. And we supply very critical, engine critical components, and that entry is very difficult. And since we have entered, it's a question of expanding the number of SKUs which we supply to them. So therefore, we are very, very confident that this is a great space to be in, and a pace of growth will be also very fast.
That was very helpful. Can you tell some of your marquee clients when you are engineering?
I think, see, in terms of the naming the clients, these clients are having a very big confidentiality, but I can just tell you the two big fleet which is operated globally, which is the 737 MAX as well as the 320, 321 neos. In their engine, we are supplying the components.
And are there any more projects in your pipeline?
In terms of which real estate project you're talking, or you're talking aerospace defense? Hello?
Hello. Real estate project.
So absolutely. You see, the testimony is very simple. In the last 6 months, we have signed more than 3 projects. We clearly are on the process of evaluating one after the other projects, and we have a strong pipeline. But since we have clearly identified the boundary conditions within which we will take the project, we get the project, evaluate the project, and then we say through that filtration process whether it is right for us to take that project or not. And then only we decide.
That was helpful. All the best. Thank you.
Thank you.
Thank you. Our next question is from the line of Raymond Demerger from Antique Stock Broking. Please go ahead.
Good afternoon, sir. My first question is on your cash flow. So you mentioned that you have net cash of around 500 odd crores in the realty business, and large project Thane is your own land where you are doing excellent job of selling and executing, and the 4 projects that have been acquired till date are under JDA, where you don't have to give significant upfront investment. So I'm just wondering, because you are selling Thane well, where you don't have to pay for any land, 4 projects also upfront, you have not paid anything. I think JDA could be the route for future growth. So wondering how you are going to use the cash flow generated from Thane project as well as the existing net cash of 500 crores. So if your path is mostly JDA, then what would be the use of those cash flows?
Yeah, Harmohan here. See, JDAs, while you don't have to pay anything on the land, but definitely it requires initial cash outlay. So typically, any project which is ranging between around 2,000 crores top line, which is what on an average it is in the city of Bombay, the peak investment on a thumb rule basis for a project like that is somewhere in the range of 300-350 crores. And then when you launch the project, that cash starts to come back. So since we would be launching 3 more projects, plus there are other in the pipeline, so there is utilization of this cash flow that we have currently. We don't see any significant capital raising, at least for the next 2 years, given the projects that we have and the cash flow visibility on the existing sales. But yes, this cash will be utilized in the business. It will not be lying idle. So it will be productively used.
And just to supplement what Harmohan said, you see, fundamentally, you have always the capability to take a project debt but the project debt will never be given for the purposes of an approval cost. And as you know, our philosophy is very clear that we want to get all the possible approvals in place so that we never start and stop a project. And that is why our execution capability is such that we can deliver our projects 2 years ahead of RERA timeline, as we have demonstrated in Thane. So I think that is also a business which is going to have a revenue in significantly in excess of 3,000-4,000 crores on an annual basis. And real estate is a business where things can go up and down a little bit. You need to have a certain cash surplus available with you, because I'll give you a simple example. During COVID, we kept 500 people at our site in order to construct 24/7. So now what happens is these are certain exigencies which come into the play, and we believe as a good prudent philosophy, we don't want to starve ever any business that is running short of liquidity, and because of that there is a delay in project. And we come from a manufacturing mindset. If you have a plant, you need to have certain cash which is available for meeting any exigencies.
Okay, that's great. Sir, I'm just trying to understand. So the future growth that in realty business that we expect to see, that would predominantly come from JDA asset light model, or it will be like 50-50 mix of asset light model and outright purchase. What is the thought there in the realty business?
So look, let me reiterate what I said in the opening remark. Thane land with 100 acres has a potential of 25,000 crores. The 4 JDAs of 7,000 crores, that totals up to 32,000 crores. And between these two, we have signed up 6 million square feet. 4 million which we have, which is currently running, which values 9,000 crores, and the 2 million of JDAs. Now, obviously, we are getting every day inundated with the JDAs offer. We evaluate. I'm pretty sure over the next few months, we will continue to acquire and more JDAs. So with this 6 million, if you have been able to do what revenue and what pre-sales of 2,400 crore, which was 4 million square feet at that point of time, I think it is very simple that nothing in Bombay sells on an average of 25,000-26,000 rupees a square feet between the Thane and the non-Thane. So I think if the company takes, and the way it is working on, a 10 million square feet under construction, you can comfortably say in the next 3 to 5 years, we are at least having a revenue potential of 4,000 crores every year. And, we have been delivering anything between 24-25% EBITDA margin with 25% IRR. So good delivery of 1,000 crores in terms of EBITDA and 25% IRR. So that puts us in a very good spot in terms of growing and developing the business further.
So that's good. But my question was the future acquisition. Would it be like heavily tilted towards JDA, or it would be mix of JDA outright purchase? That was my question.
No, at this juncture, we are very clear that we are moving towards JDAs because there is enough and more opportunities in JDAs. So we are not going to invest today to tomorrow into land unless something very, very nice or something very attractive comes. But 99.9% our focus is on building on JDA capability. There is enough and more opportunity available. Our chairman has outlined in one of the briefings that he believes that over a longer period of time in Mumbai itself is a $2 trillion JDA opportunity.
Okay. And just last question on this. Just can you give some color on this, the existing 4 JDAs, like what kind of revenue share on a ballpark level that we have to give to our partners?
So, Viplav, every deal is different. Very difficult to say that what's the kind of... See, each micro market pricing is different. Then the dynamics of the deal could be different. Sometimes the deposit requirements may vary for the landowner, and also the product that we do may demand different cost dynamics. So as far as sharing ratios are concerned, they are different from deal to deal. Even the 4 deals we have done, they are all different, but we are very clear of the boundary conditions that we want to follow. I mean, one of the things that I mentioned to you is in terms of average size and the peak investment that we are looking at. And we look at a multiple of that peak investment coming to us in the form of the return. Basically, we target for about 25% IRR based on all these boundary conditions. And that's how we look at the deal, whichever way, you want to look at. Whether it is higher deposit and lower sharing ratio or higher sharing ratio and lower deposit, or there could be some other moving parts. But eventually it should give us a minimum return. That is what we are targeting for.
Okay, that's good. I'll come back in.
Yeah.
Thank you.
Thank you. Our next question is from the line of Nishant Sharma from Nuvama. Please go ahead.
Thank you for the opportunity. I hope I'm audible.
Yes, please. Yes, please.
Yeah, thank you. First of all, many congratulations. Since the last time when we had discussed about the demerger of lifestyle business, you have created a significant value unlocking for shareholders. So first of all, congratulations on that front, and I hope to get a similar kind of value unlocking happening for this real estate business as well. My question is more towards engineering business. So earlier we had just two business. One is the files business and the auto component business, where broadly we had the revenue of about 800 to 850 odd crore. The new acquisition which you just talked about, can you just give us more specific in terms of what would be the total sales and what was the deal price for that or the multiple for that?
Sure. First of all, thank you. And I think we really appreciate the kind of commitment shown by the investors towards Raymond. And we are in that journey. And as I outlined, I think we are clearly doing one after the other steps in order to support and unlock the value. So thank you so much for that. Now, coming to the engineering, I think fundamentally our focus was very clear that our business of engineering between Ring Plus and JK Files in that run 900 odd crores revenue. And it was a business which had a certain growth level, and it was not in the highest level of technology which was growing fast. So we were on a scout mission, so to speak, to see what is the right business which we can get. And Miny Precision came on our way, where very clearly we found that you have the auto components business, which fits in very well with our strategy. And the combined business between Ring Plus and the Miny Precision auto business turns out to be close to 1200 odd crores. And also that we got into aerospace and defense. And that is a business which is roughly clocking on the run rate of 300 crores. So total business of Miny is roughly 900 crores, delivering an EBITDA of close to 140 to 145 crores. And we bought at a multiple enterprise value of 10x. And that is where the whole thing was. We know that integrating between the two businesses, there is a great opportunity. If I look at it, the top 15 auto OEMs globally are covered by us, either by the Ring Plus or by Miny Precision. And it is very important with the auto players is that you have a foot in the door. Once you have the foot in the door, your ability to expand from one component to 2 to 5 and to 10, that brings you a greater opportunity. Similarly, if I look at in the consumable space, again with the files, we have a great opportunity, and some of the skill sets which are available in the Miny Precision, we can integrate some of the facilities. You will have the synergy benefits. You will have more capability as a group. Now we will be a larger group by the Miny Precision. And the way we have structured is that Gautam Maini, who was the promoter of the Miny Precision, we will consolidate all our engineering business, and he will be the CEO for the entire engineering business, with Ravi Uppal being the chairman of the engineering business. So that management bandwidth also we have got added. So I think overall as a business, we see a lot of opportunity, and we got into the sunrise sector of aerospace, defense, electrical vehicle components. So all in all, there is a great future growth potential we are seeing in this business.
In terms of production capabilities, if you can throw some highlights, what kind of capacities that we have and what kind of a utilization that we and bring it out, and at a peak utilization, what could be the revenue which we can generate from those capacities?
So look, as far as the mining